Well, our next guest expects one more Fed rate cut. That's going to be in December, then two more next year. And that's a lot less than the six that's being priced in by the markets. Let's get some insights now from Alexandre Drabowicz, global CIO of Indo-Suez Wealth Management, which manages $250 billion in assets. Alexandra, thanks so much for joining us today. And I just want to start by inviting you to add your voice to that chorus. We got 25 basis points. That's pretty much as everybody was expected. But still a note of caution there from Jay Powell, particularly around inflation. Do you share those concerns?
Thank you, Paul, and good morning. I will highlight actually three key takeaways for me from this FOMC meeting overnight. The first one is there is a lot of unity behind this rate cut. So I think there's a clear message that Powell managed to get everyone on his side to show the clear independence from the Fed. Naturally, Miran only dissented for 50 basis points. The second two key takeaway here is that behind the dovish plots, because yes, indeed, the market or the Fed is expecting another two cuts, there's a lot of dispersion. We are 3 months away from the end of the year. We only have two meetings. You have 6 members looking for no cuts, 9 members looking for 2 cuts. There's 1 member looking for 5 and 1 looking for a rate hike. So this is quite unusual with so little time before the end of the year to see this dispersion. So we are still looking ourselves for one additional cut. Could be 2, could be 1. I think the how this is going to be managed over the next 6 months will depend also on the future path of inflation. And importantly, the third point is that when you look at the Fed projections, for me, there's a kind of a hawkish twist. Powell actually revised slightly growth up. It doesn't change unemployment expectation, and even inflation is going up. So all in all, if I would actually summarize what Powell said, it's risk management. For me, it's really recession risk management.
Yeah, and some of those questions also being raised around the jobs market, in Jay Powell's words, no longer very solid. So what's your outlook for the jobs market as well? And can you tell us a little bit more about how you view recession risk in the US?
Well, I think the economy is cooling in the US, that's for sure, but it's not cold. Indeed, the job revisions have been significant. We also know that immigration in the U.S. has ticked down, so it means that the unemployment rate actually is getting stable, and the job creation, which was estimated to be necessary to 150,000 a month earlier, is probably closer to 70,000. But when we look at forward-looking data, and I'm thinking more at high-frequency data, whether it's temporary staff hiring, whether it's retail sales that we recently seen, or credit card data, they are actually looking pretty good. So from our point of view, the U.S. consumer remains resilient for now. Yes, the unemployment rate can tick up a little bit, but we don't see a collapse. The hiring rate is slowing for sure, but the layoff rate is not ticking up. So there is some comfort on that side. And you look at GDP, final point, GDP is tracking at 3.2% actually for the third quarter. It's very, very far away from any recession risks.
Yeah, I mean, you do describe, and some of our other commentators have pointed this out as well, that the U.S. economy is in reasonably good shape. Is this one of the reasons that you don't expect to see quite so many rate cut reductions as some of the other commentators?
Yeah, absolutely. At the end of the day, we are aligned with basically what the Fed is expecting, which is, to bring down rates to about 3.5%. It will have actually to see a significant deterioration in the employment situation to actually go for further cuts. But I think the key risk for our projections today is how the new members of the Fed are going to look like. So we know that the new members that are going to come on board are going to be certainly much more dovish. Now, is that going to be enough to convince all of the members to be much more dovish? That's going to be the key question for 2026 and the risk to our call for only an additional 3 cuts.
Well, we got a new set of dots as well. It was kind of interesting also that there was just the one dissent. Unsurprisingly, it was Stephen Miran, the new member. But when you're looking at the dot plot, thinking about some of the commentary from the chair, Jay Powell, has that led you to change any of your allocations, or do you feel like your expectations heading into that meeting were pretty much vindicated?
No, pretty much as expected. At least the Fed didn't signal any hawkish message, and I think the market had high expectations coming into this meeting. So maybe Powell is trying to manage expectations, but he doesn't want to go against expectations. So we remain actually overall constructive on equities, and we have been so for quite some time from the second quarter. We do admit that there are some areas of valuations that are maybe a bit expensive in the US, so we are playing more the broadening of this equity market, really, particularly on the small cap segment, which has been frustrating, to be fair, in the first half of the year. But with these expectations of rate cuts in the past 3 months, actually small caps have started really to catch up significantly, and we believe there is additional catch-up possible on small caps in the US.
And how about emerging markets as well? Because 6 months ago you expressed that you quite liked emerging markets. Is that a view you still hold? And in particular, through the lens of the surprise rate cut we got in Indonesia as well?
Absolutely. So emerging markets have been a key conviction. Remember that we already changed our view on China back in October and had a much more positive stance on China and the rest of Asia. We have actually recently reinforced this emerging market conviction over the summer, where we had been over the first half of the year a bit more overweight onto European equities, and we have decided to reallocate capital to emerging markets. And by the way, year to date, emerging markets have basically recorded twice the return of the S&P 500. I'm actually struck when I come to Asia, and I was a couple of days in Hong Kong and now in Singapore, that the mood has totally changed. There is a lot of liquidity in this market. Clients are much more optimistic, and we have this diffusion of artificial intelligence coming to AI, potentially because in the US it's expensive, and investors are looking basically to get more exposure to the AI theme in Asia. So we believe there is still significant potential on emerging markets. Valuations are not expensive at all compared to the US. You also have tailwinds because the US dollar is weaker, and that's good for emerging markets in general. And overall, we believe that investors continue to under-own emerging market equities.
Well, before we let you go, Alexandre, we have one more major rate decision coming up this week. It is, of course, the Bank of Japan. We're not expecting to see any change there, but in your view, where is the bar for further tightening?
Well, I'm not sure if the Bank of Japan actually knows. They've been trying basically to raise rates for the past 12 months and have been unable to do so. We have some political issue when Ishiba-san actually also resigned. The economic situation is still, quite weak. We know the government is also trying to, again, do some fiscal stimulus. So it's kind of a weird situation from the Bank of Japan. Real rates are extremely negative, but at the same time, they need to support the economy. They also have to be mindful of the bond market. As this year, the 20-year and 30-year JGB yield has risen significantly. So maybe the topic for a rate hike is somewhere in the course of 2026, where you will have probably to raise rates by 1 or 2/4 of a point. But I think the main focus right now is more the bond market. They attempted to taper the JGB bond purchases, and they can see that the steepening in the yield curve can actually put pressure on the economy. Maybe at some stage you would have to do some yield curve control again. So no rate hike this week, a topic for 2026.
All right, Alexandre Drabowicz, Global CIO of Indosuez Wealth Management. Thank you so much for joining us today.